One of the biggest surprises in the municipal market this year was the inversion of the yield curve, the first ever inversion of the yield curve. There's a couple of reasons for that. One is significant Fed action, the rising of interest rates, and significant retail or individual investor demand 10 years in it. Typically, when you'll see the Treasury curve invert, that happens and it's usually a precursor to a recession. But the municipal curve, because it's got credit, it's a credit curve, you need to get paid for taking on risk, that typically doesn't invert. But this year, because of what was the significant action on the front end of the curve from the Fed, really had a huge influence on the municipal curve. That coupled with reduced supply in the muni market and still strong investor demand. But now that the Fed is almost complete, or we believe, complete with its tightening cycle, most of the rise in rates is already priced into the market. So we think right now is a very good time to look at going out longer on the curve, locking in some higher rates, especially in the single A revenue sectors. The reason being is the yield curve is steeper and you're picking up more spread because the credit curve is steeper as well. So where we're seeing potential opportunities are in single A revenue bonds, longer on the curve where you're picking up the benefit of both the steepness of the yield curve as well as additional spread for every unit of risk that you're taking. On the shorter end of the curve, because there's such strong individual investor demand, you're not getting paid the same. You're not getting paid the spread. You're not picking up that spread. So you get a double-decker, as we like to say, benefit from investing longer on the curve in sectors such as higher ed, hospital, and transportation. The question that we get a lot about investing shorter on the curve versus longer on the curve is basically locking in those longer, higher yields with attractive valuations for longer term investors. If you stay short on the curve, there may be a missed opportunity later on.